Good morning, everybody. Welcome to Transaction Capital's results presentation for the half year ended 31 March 2021. My name is David Hurwitz. I'm the CEO of Transaction Capital, and I'm pleased to be presenting our results to you today. Let's start with an overview of our group's performance during this first half of 2021, a 6-month period characterized by Transaction Capital's decisive recovery from COVID. We're extremely pleased with our strong operational and credit performance, delivering excellent financial results. During the first 6 months of 2021, Transaction Capital resumed its long-term track record of growth. Headline earnings and headline earnings per share have grown by 56% and 43% respectively. Like most companies in the world, COVID impacted our 2020 results last year. For the first time ever, earnings dipped and we did not pay a dividend. For this reason, we feel that 2019 should be used as a base. And I'm very pleased that this year, both headline earnings and headline earnings per share have exceeded the 2019 benchmark. In addition, Transaction Capital has resumed dividend payments. Our long-term track record of growth continues at rates similar to pre-COVID rates, which is high teen percentage HEPS growth. Our compound annual growth from 2014 to 2021 in headline earnings is 17%, in HEPS is 15%, and in dividends per share is 18%. This has resulted in shareholder returns of 32% per annum, in aggregate over the 7-year period on a compound annual basis. The resilience of our businesses, their strategic market positioning, and the agile response of our entrepreneurial management teams has been demonstrated, evidenced by Transaction Capital's strong earnings recovery. Using 2019 as a base, pre-provision profits is up by 39% and headline earnings are up by 29%. Our balance sheet is robust, with 1.1 billion of new equity raised over the last 12 months, which enabled the value and earnings accretive investment into We Buy Cars. And despite this issue of additional shares, HEPS is up 18%. Finally, Transaction Capital has unfettered access to debt, with large undrawn facilities at holding company and divisional level, enabling the implementation of our growth strategies. Strong earnings, high cash conversion rates, and our robust balance sheets facilitated a 19 cents per share dividend. This slide provides an excellent summary of the components of Transaction Capital's performance for the 6-month period. This was a combination of organic growth from our existing divisions, SA Taxi and TCRS, plus acquisitive growth from our investment in We Buy Cars. SA Taxi's finance and insurance division recovered quickly. Gross loans and advances grew by 16%, an 11.8 net interest margin remains within our internal target range of 11 to 12%. Credit losses are recovering from a high at September 2020 of 7.3% to 4.6%, still slightly above our internal target range of 3 to 4%. And non-interest revenue has fully recovered to be 4% above 2019 levels. This all resulted in SA Taxi growing its earnings by 13% when compared to 2020, with earnings fully recovered to be 4% above 2019 levels. At TCRS, investment activity and collection performance has been outstanding. Our 385 million rand investment into NPL portfolios is nearing 2019 levels of 437 million. Driving non-interest revenue 30% above 2019 levels. Principal revenue from our NPL portfolio is well above prior years, and contingency collection revenues have recovered to be 2% above 2019 levels. This resulted in TCRS growing its earnings by 27% when compared to 2020, with earnings again fully recovered to be 11% above 2019 levels. As a whole, our existing divisions, SA Taxi and TCRS, were able to grow earnings by 18% above 2020, with earnings fully recovered to be 6% above 2019 levels. This is all organic growth. At We Buy Cars, the number of vehicles purchased and sold have continued to grow year on year from 2019 to 2020 and into 2021, driving headline earnings up to 257 million rand, 38% above 2020 and an astounding 84% above 2019. Transaction capital consolidates just under half of these earnings, or 113 million rand. The combined effect of this organic and acquisitive growth has resulted in transaction capital increasing headline earnings per share by 43% and even by 18% if you use 2019 as a base. All stakeholders at Transaction Capital should be very proud of this result. From an operational perspective, the first half of our 2020 financial year, from October 2019 to March 2020, was not at all impacted by COVID. The second half of our 2020 financial year, however, from April to September, was characterized by significant COVID disruption. I'm very pleased that across all three businesses, current operational activity is near to or exceeding pre-COVID levels. At SA Taxi, loan applications, loan origination, repossessions, and insurance policy origination have exceeded pre-COVID levels. At about 95%, loan collections are near to pre-COVID levels, and for this reason, NPLs are at 27% and continue to recover month on month. At TCRS, both investment and activity into NPL portfolios and collections are almost at pre-COVID levels, in line with our expectations articulated at the time of our 2020 full year results. We still feel that unprecedented opportunities exist to accelerate investment into NPL portfolios over the medium term. And finally, at WeBuyCars, the number of vehicles purchased and sold has exceeded pre-COVID levels significantly, and the strategy to sell vehicles online via our e-commerce platform has increased almost 10 times, from about 4% to roughly 40%. It is clear that this financial result is underpinned by a robust recovery in operational metrics. From this slide, you can see that the investment into WeBuyCars has taken TC into a new adjacent market, diversifying our earnings further, reducing risk, accelerating growth rates, and expanding our existing total addressable market. Certainly the most recent highlight, and perhaps the most exciting, relates to the cautionary announcement released this morning. Transaction Capital is in the process of negotiating an increased shareholding in WeBuyCars. Upon completion of this process, we will increase our shareholding from 49.9% to 74.9%, with the remaining 25.1% owned by the founders, Faan and Dirk van der Walt. This increased investment reinforces Transaction Capital's confidence in our initial investment case, with growth opportunities initially identified, all being validated. This is supported by favourable market trends and WeBuyCars' strong position in the sector, the cultural fit and positive engagement with the founders and management of WeBuyCars, the proven high calibre of WeBuyCars' management team, the operational resilience of WeBuyCars displayed in this difficult environment, and finally, WeBuyCars' recognition of TC's ability to advance their finance and insurance offering to increase unit economics. Upon completion, this investment should enhance TC's future value and earnings trajectory for two main reasons. Firstly, the future earnings growth rate from WeBuyCars has exceeded our expectations and is actually higher than TC's historical growth rates. And now, TC will consolidate a greater proportion of this high growth earnings going forward. A medium-term opportunity relates to international expansion, given the growth trajectory of the digital used vehicle industry globally, and because WeBuyCars compares so well against its international peers. Let's now look at some of TC's other strategic highlights. Despite focusing on a recovery from COVID, TC was still able to achieve some amazing strategic goals during the period. Firstly, our business models established over the last 2 decades have demonstrated their resilience and responsiveness to COVID and have gained in relevance in this COVID environment. At SA Taxi, minibus taxi remains the largest and most vital service in the public transport network, whilst other modes of public transport have floundered. At TCRS, COVID has increased indebtedness and impaired consumers' ability to service their debt, creating larger NPL portfolios for TCRS to manage or acquire. And at We Buy Cars, as consumers' disposable income is under strain and new vehicle prices continue to increase, consumers continue to opt for used vehicles, driving growth in the sector. Next, our balance sheet has been proven to be resilient, underpinned by conservative equity and debt strategy. TC has enjoyed unfettered access to the debt and equity capital markets, providing us with ample capacity to fund strategic growth initiatives. This capital strategy enabled TC to complete its earnings and value accretive investment into We Buy Cars towards the end of our last financial year, in the midst of COVID. Other group highlights include enhanced digital adoption, accelerated in part by COVID. At We Buy Cars, we have driven greater e-commerce adoption, with approximately 40% of vehicles sold via our online auction on our e-commerce platform, up from 4% a year ago. At SA Taxi, we apply leading-edge analytics to real-time vehicle mobility datasets to monitor the industry's recovery and adjust operations in line with industry activity. And at TCRS, we have implemented highly effective work-from-home capabilities, yielding higher productivity driven in part by flexible working hours. We continue to enhance our ESG frameworks, including measurable ESG reporting. We continue to augment the skills and independence of our board with the inclusion of Albertina Kekana as an independent non-executive director. And finally, our strategy to invest into innovation continues with the establishment of TC Ventures, where we will partner with and invest in innovative entrepreneurial businesses targeting digitally enabled fintech disruptors requiring leadership skills and financial capacity. Undoubtedly, the most significant recent strategic highlight is TC's transformational investment into We Buy Cars at a time when most businesses in the world were completely inwardly focused. This investment was immediately value and earnings accretive to TC. It expands our earnings base by creating TC's third adjacent market vertical and positions TC for growth in years to come. From the graph at the bottom of this page, you can see that We Buy Cars has reached new heights in several categories during this period, including units bought and sold, but also in total revenue, e-commerce trading, and total bays, and of course, earnings. We Buy Cars is an exceptional business, driven by its data, e-commerce, and digital capabilities, with a high quality and predictable earnings track record proven over 2 decades, high cash conversion rates, and robust organic growth prospects. It's an entrepreneurial, founder-led business, with the founders still actively involved and materially invested. And it's uniquely positioned in South Africa's large and resilient used vehicle market, with favourable structural market conditions. Our relationship with the founders and existing shareholders of We Buy Cars is off to a great start, one of the reasons why we're in the process of increasing our stake to 74.9%. SA Taxi's strategic highlights include the resumption of its earnings growth track record, driven by loan applications, loan origination, repossessions, and insurance policy origination, all exceeding pre-COVID levels. Loan origination volumes were supported by the continued momentum in the sale and finance of pre-owned taxis. Again, from the graph at the bottom of the slide, you can see that collection activity recovered to about 95% of pre-COVID levels by December 2020, but unfortunately were disrupted in January this year to about 85% when risk-adjusted level 3 restrictions were implemented. Collections then increased month on month from January to February to March. A medium-term strategic initiative remains the development of a transactional-based account for the minibus taxi industry. TCRS's strategic highlights include its quick recovery in earnings, up 27%, driven by collections revenue growing by 7%, coupled with significant operational leverage. You can see from the graph at the bottom of the slide that collections on our owned NPL portfolios have performed better than expectation, currently at about 95%. This strategic realignment of TCRS is complete, with the integration of TCPS, First and Axis into a single scaled transactional services platform and the appointment of a CEO and COO. The disposal or wind down of Principia and TCBS being done, and road cover now positioned in SA Taxi to augment its growth prospects. Medium-term strategic initiatives include to co-invest in European NPL portfolios with local partners and the establishment of a business outsourcing services division, leveraging TCRS's low-cost SA technology and infrastructure. Let's now focus on TC's newest market vertical, We Buy Cars. This slide provides context regarding the South African used vehicle market. Personal vehicle ownership is an aspiration rooted in South African culture. In South Africa today, there are about 10.8 million vehicles, with 23% of households using personal vehicles as their main mode of transport. The local vehicle park has grown steadily over the past 10 years, despite new vehicle sales reducing over this period, making the used vehicle industry resilient, defensive, and growing. The block on the right-hand side of the slide shows that in 2020, about 463,000 new cars entered the park and approximately 350,000 were written off, showing growth in one of the worst years ever. In an average year, South Africa experiences about 450,000 to 500,000 new vehicle sales, of which roughly 46% are financed, and 1.1 to 1.2 million used vehicle sales, of which roughly 32% are financed. For every new car sold, 2.4 used cars are sold. More recently, consumers have shifted from new to used vehicles, driven by affordability constraints as new vehicle prices increase and as disposable income comes under strain. Another factor adding towards the structural shift is the bank's growing appetite to fund used vehicles, further stimulating growth in the sector. For these reasons, over the past 5 years, new vehicle sales have reduced by 3.6%, but used vehicle sales have grown by 1%. Finally, South Africa has experienced a strong recovery in used vehicle sales, which are already back to pre-COVID levels. It is clear that We Buy Cars is a high-quality standalone business with strong organic growth prospects, favorable structural market conditions, and a business model that is highly relevant to this COVID environment. This places We Buy Cars well to build on its long-term track record of growth. Our organic growth prospects include a medium-term target to increase the volume of vehicles traded to 10,000 per month. This will be achieved by harnessing data, technology, and e-commerce potential with specific focus on our B2C e-commerce capabilities and the expansion of our physical infrastructure to increase space and meet demand requirements. We Buy Cars will also enhance unit economics by increasing the take-up rate of F&I products, enhancing existing arrangements with providers of these F&I products, adding new allied products, and finally, offering finance, insurance, and other products as a principal. We Buy Cars' financial performance has been outstanding. This is a high-growth business, well placed to build on its long-term track record of growth. Headline earnings increased by a staggering 38% to 257 million, delivering 113 million of earnings to transaction capital for the half year. You can see that We Buy Cars has the potential to accelerate transaction capital's growth rate. Its 2-year compound annual growth rate from 2019 to 2021 in headline earnings is 35%, in revenue is 32%, and in EBITDA is 39%. Over this period, operational leverage has been achieved, and margins have remained stable despite strong growth. There is also an opportunity for We Buy Cars to increase unit economics per vehicle sold from greater take-up of F&I products. Finance and insurance product margin is earned on about 13% of all vehicles sold by We Buy Cars. For every 1% increase in this penetration rate, earnings increases by roughly 11.6 million. This slide shows that significant growth in volume and value has been achieved, made possible from operational excellence. We've experienced a very quick recovery from COVID, with favourable structural market conditions continuing to support the business. Current volumes of vehicles traded per month, either vehicles bought or sold, by far exceeds volumes traded prior to COVID. Enhanced digital adoption, accelerated in part by COVID, has driven greater e-commerce activity, with approximately 40% of vehicles sold via online auction on our e-commerce platform, up from 4% a year ago. This assists greatly in increasing volumes traded and improving stock turn. In addition, the average selling price per vehicle has increased to about 112,000 Rand from about 103,000 Rand a year ago. Let's now spend some time looking at SA Taxi. The minibus taxi context remains unchanged. The industry is defensive and growing, with resilient operators despite a challenging environment. This is driven by structural elements that support the minibus taxis industry's resilience, including that it is the largest and most vital mode of transport within the integrated public transport network. Since 2013, minibus taxi usage has increased by 16%, completing 15 million commuter trips daily. In comparison, bus and rail have decreased by 28 and 64% respectively, and together complete only 1 million commuter trips daily. Growth in the minibus taxi industry is driven by the industry's ability to operate with no government subsidy, the fact that it is indispensable to SA's economic productivity and an early beneficiary of economic and social recovery, and that commuters rely on minibus taxis given their accessibility, reliability, convenience, and flexibility. The final structural element driving industry growth is that demand for minibus taxis by far exceeds supply. Regardless, we see a very challenging environment for minibus taxi operators, with profitability impacted by lower COVID-related commuter mobility and higher vehicle and fuel prices, despite lower interest rates. For these reasons, fare increases have been passed during the last 12 months, which are unfortunately not sufficient to offset the above negative impacts. At SA Taxi, we apply leading-edge analytics to real-time vehicle mobility datasets to monitor the industry's recovery and adjust operations and credit and insurance risk appetite to be in line with industry activity. This data provides empirical evidence proving the following. First, COVID proved that the minibus taxi industry is indispensable. As the dominant mode of public transport, the minibus taxi industry is an essential service and operated during level 5 lockdown at significantly lower levels of activity. In addition to the reduced activity per vehicle, COVID restrictions also resulted in lower passenger loads. The next thing we see is a quick recovery and transition towards normal activity as restrictions are eased and the economy reopens. This is because commuter mobility is a precursor to any economic activity, and spending on minibus taxis is non-discretionary, making this industry defensive. The last thing we see is that operators are able to afford loan and insurance installments and make a profit, supported by fare increases and lower interest rates. SA Taxi's operational and financial performance was excellent. Headline earnings increased 13% to 228 million, with TC's attributable portion increasing 15% to 188 million. A net interest margin of 11.8% was achieved, which is within our internal target of 11 to 12%. Non-interest revenue of 366 million has recovered to be above 2019 levels, and gross written premium of 497 million is 8% above 2020 and 25% above 2019. SA Taxi's credit performance was robust and is improving, trending closer towards our internally set targets. Gross loans and advances increased by 16% to 13.2 billion. Growth was driven by applications recovering to be in line with pre-COVID levels, with the number of loans originated exceeding 2020 and 2019. And of course, our strategy to focus on the sale and finance of pre-owned taxis, which has really paid off. Firstly, because pre-owned taxis are an affordable but reliable option for minibus taxi operators when compared to the more expensive new vehicles, and also because new vehicle supply has been constrained throughout COVID. Loan originations relating to pre-owned taxis grew by 47%, while loan originations relating to new vehicles contracted by 3%, and repossessions have recovered to pre-COVID levels. The NPL ratio continued to improve to 27.1% from 32.3% at September 2020, as collection activity approaches normality. And the credit loss ratio has also improved to 4.6% from 7.3% at September 2020. Finally, provision coverage remains adequate at 6%, protecting our balance sheet. Let's now focus on TCRS. The South African macro and socio-economic environment is challenging, placing pressure on consumers who continue to be adversely impacted by COVID. In South Africa, there are 39 million adults, 27 million of which are credit active, and 10.6 million, or 39%, are considered to be non-performing or in arrears. Surprisingly, this ratio has improved from 42% in December 2019. We experience elevated levels of unemployment at 32.5%, which is the highest in 12 years. Household debt to income has increased to 77.1%, up from 72.8% in 2019, driven by a deterioration in household income over the past 3 years. Resulting from this adverse environment, about 34% of households are expected to exit the middle class and roll into more vulnerable groups due to COVID. The sector where TCRS focuses, being unsecured loans, reflect significant levels of arrears, deteriorating by 23% year on year. Almost the only positive factor is that the cost of servicing debt has reduced to 8.5%, down from 9.4% in December 2019. Our own index, the Transaction Capital Consumer Credit Rehabilitation Index, shows that the consumer's propensity to repay debt is deteriorating, with weak economic conditions exacerbated further by COVID. TCRS is defensively positioned in this context, and its business model has gained in relevance since COVID. We see increased unemployment and increased indebtedness, impairing the consumer's ability to service their debt. TCRS's clients have larger NPL portfolios than ever before. Their balance sheets and operations are under pressure, and they are all trying to shift from fixed to variable cost structures. This, together with the consumer's impaired ability to service their debts, increases our clients' appetite to sell NPL portfolios or to enter into outsourced collection arrangements. TCRS is strongly positioned to accelerate the acquisition of NPL portfolios and win agency collection mandates, specifically as regards our successfully established work-from-home capabilities, where we have more than 1,200 agents working from home at increased efficiency and productivity. In Australia, the consumer is employed but highly leveraged, with household debt to disposable income exceeding 200%. As government support programs terminate and banks cease debt moratoria programs, TCRS expects larger NPL portfolios to become available for purchase or outsourced collection. Market dynamics for participants in this sector include reduced access to funding, increased regulatory compliance, lower sales of NPL portfolios and heightened competition, and a shift towards fee-for-service. Despite this environment, a small position in this large and fragmented Australian market provides a meaningful opportunity for TCRS to grow its agency and NPL acquisition business, where we currently have a very small market share. TCRS's diversified business model enables it to perform well in a positive and a negative environment. Firstly, TCRS is diversified across 3 business activities: collection services, transactional services, and business outsource services. Within its largest business activity, collection services, TCRS has a diversified revenue model, allowing TCRS to be defensive. Agency collections thrive in a positive consumer environment, whilst a negative consumer environment is conducive for the acquisition of NPL portfolios. TCRS is further diversified across geographies, sectors, clients, mandates, and individual consumer accounts. This all positions TCRS defensively, and in a very difficult year, TCRS was able to grow revenue from collection services by 7%, SA collection revenue by 8%, and Australian collection revenue by 5%. This is all organic growth, an excellent result given the difficult consumer environment heightened by COVID. This slide shows that the investment activity and collection performance have both been good. Our R385 million investment into NPL portfolios has almost normalized and is nearing 2019 investment levels of 437 million. Our asset base, or carrying value of acquired NPL portfolios, at 2.7 billion is flat year on year, but 57% above 2019 levels. This has driven principal collection revenue up 12% in total, with revenue from principal collections in Australia growing by 31%. Looking forward, expected remaining collections has grown by 11% to 5.9 billion, supporting strong annuity cash flows and predictable growth in the future. It's important to understand that TCRS has the ability to adjust its pricing methodology to the prevailing environment. This ensures that future NPL portfolios are priced with the environment in mind to achieve targeted returns and collection multiples. TCRS's operational and financial performance was excellent. Pre-provision profit increased 21% to 363 million rand and is 44% above 2019. Headline earnings increased 27% to 131 million and is 11% above 2019 levels. This was driven by non-interest revenue increasing 8% and core operating costs only increasing by 3%. The cost-to-income ratio for this reason improved to 83.5% from 86.6%, driven by the proactive restructure of TCRS's staff complement and infrastructure during 2020. This included the implementation of a highly effective work-from-home capability with more than 1,200 agents working from home at increased efficiency and productivity. This should yield about 90 million rands of cost savings into 2021 on an annualized basis and has allowed TCRS to continue to write down the carrying value of purchase book debts at rates similar to those used during COVID, protecting our balance sheet and future earnings. This brings the presentation to its conclusion. In summary, Transaction Capital has experienced a strong operational recovery, with current operational activity near to or exceeding pre-COVID levels due to our agile and flexible response to COVID. This has resulted in a decisive earnings recovery driven by organic growth from SA Taxi and TCRS, coupled with acquisitive growth from our investment in WeBuyCars. This enabled Transaction Capital to resume dividend payments with our dividend policy unchanged. We have a resilient balance sheet with ample capacity to fund organic and acquisitive growth strategies. Our business models have demonstrated their resilience to COVID and have gained in relevance in this COVID environment. We continue to enhance ESG frameworks and ESG reporting, and we continue to augment the skills and independence of our board. An exciting opportunity is for TC to increase its shareholding in WeBuyCars, enhancing TC's future value and earnings trajectory, as the future earnings growth rate from WeBuyCars has exceeded our expectations and is higher than TC's historical growth rates, and TC will now consolidate a greater proportion of this high growth earnings. This all places Transaction Capital well to build on its long-term track record of growth this financial year and beyond, in line with pre-COVID-19 levels and applying 2019 as a pre-COVID base. This brings the presentation to an end. We now have about 20 minutes for questions. I'm joined on the stage by Sean Doherty, the Group CFO. We're open for questions now, and I'm going to start off by just going on to Chorus Call to see if there are any questions that have come through on the Chorus Call line.
Thank you. Ladies and gentlemen, just a reminder that if anyone would like to ask a question on the conference call, that you are welcome to press star and then 1 on your touchtone phone or on the keypad on the screen. We will just pause a moment to see if we have any questions coming through. We have a question from Kiamo Kunopi of SBG Securities.
Morning, David. Thank you for the presentation. I have just 3 questions from my side. So just looking at TCRS, the estimated remaining collections multiple sort of remain at multi-year lows. What would need to change in order for an upward IRC revision to take place within the next year or 2? And second question is, can you please unpack SA Taxi's NRR, which grew 2% year-on-year despite strong originations in the business, and where you see this trend sort of going into H? And lastly, can you please also comment on the progress made since March in managing the splits between dealer and consumer sales in WeBuyCars, and how this has impacted F&I penetrations?
Okay, great. Thanks, Kiamo. Starting off your first question on the expected remaining collections. Expected remaining collections actually have grown. It's certainly not at a all-time low. I think what has remained flat is our book. So if we go from 19 to 20 and then into 21, from 19 to 20 we saw fantastic growth in our book. And then what we saw in the 20 year was that we saw very high levels of amortization because of COVID, or a write-down of that portfolio. And we also have seen slightly lower book buying activity. So our book remains stable year on year. But we have seen from our increased collection activity and our growth in collection revenues, we actually have seen expected remaining collections grow. I think the number I have in my head, you can confirm it, Sean, is about 5.9 billion. Right. So we have seen nice growth in that, and that actually bodes very well for future collection revenue coming outside of TCRS. Your next question went to non-interest revenue at SA Taxi. What we've seen in SA Taxi is good growth in insurance as originations have recovered, but we still see a higher lapse rate than before because our collections haven't yet recovered to 100%. And if there is a missing collection, that typically goes to insurance first, particularly with our clients in the open market that aren't insured, that aren't financed by us. So I think we've seen a nice strong recovery in insurance, but still a slightly high lapse rate, growing, I think it was 4% or so NIR in total, which really shows, that we're getting back to 2019 levels. I think it's hard to expect a big growth above 2019 and 2020, remembering that insurance grew well from 19 to 20, and we're actually very pleased with that result. On the last question, it's hard for me to remember 3 questions on a call, but I think you spoke about the mix between sales to dealerships and sales to consumers. I'm not sure if you're referring specifically to online or in general, but we like a good mix of sales to dealerships and consumers in general. At 40%, we feel that that's a nice ratio, and dealerships allow us to do sales relatively quickly. So it helps with stock turn, but on the other hand, we lose out on the ability to sell finance and insurance products when we sell to a dealership, and hence also the consumer model. So we do like that mix. From an e-commerce perspective, at the moment, most of our e-commerce activity is into the dealership base, being B2B, with B2C starting to get some nice traction, but is still at very early stages.
Okay, thank you. And David, so just on the estimated remaining collections, I was referring to the multiple, which is reduced from 3.1 times in 2020 to about 1.8 times in 2021.
I'll answer that, Sean. Yeah, I think Sean will answer that.
Sure, Kiamo. So generally what you'll see in all of our presentations going back, the last 6 months where we show that ERC, you'll generally see it around about that 1.8 to 2.1 level, and as we work the books, so that ERC will increase. So that's really the reason. We are a little bit conservative as we put these onto the book and as we show it to you guys. So no, it's not at all-time lows. It's just these are new books. The only other item I would mention in that is as we buy higher cash books, so obviously this cash comes back at us quicker, and that multiple might be slightly lower. But you can expect to see that increase as we get towards the end of the year.
Yeah, and the other thing, just to add to what Sean has said, is that as we activate matters in the book, so that multiple grows. And you can go back through all the years, you'll always see our most recent vintage, in this case the 2021 vintage, normally hovers at around 1.8 to 2 times. And then as we get more history on that book, you'll see those vintages move up slightly. So it's a combination of conservatism at the outset, a combination of activating clients as we move along, and then finally a slight mix in the products that we're buying, written off versus legal versus high cash books.
Okay, thank you.
Any more questions on the conference call?
We have a question from James Stark of RMB Morgan Stanley.
Hi,
Okay,
good morning,
James.
David and Sean. Good, thank you. Just one quick one, really. You mentioned when you speak about SA Taxi, the potential to develop a transactional account. Can you give us some color on the thinking behind the product and perhaps some context to its functionality?
Yeah, so this really is a longer-term strategy. Essentially what we're trying to pull together is, first of all, the rewards programs which are already in place. So we have rewards programs. They are typically card-based. We've added on quite a few additional service providers. I think if you go to slide 52 or 3 in the pack, it will be in the annex, so you'll see what we've added on. That gives us fantastic data around what people are buying, when they're buying. We then have telematics data around movement and where people are. And again, this can inform buying decisions. So if somebody buys a set of tires, we can track how many kilometers they've done. So we've kind of brought that information together. And the next piece is to try and put that into a transactional-based account that the minibus taxi operator can utilize. So you'll have rewards together with some type of card with transaction capability on it, and also potentially some type of credit limit. They don't all have to be debit. There can be credit limit on that as well. And that will get that again will give us greater spending data, or data around the spending habits of our operators. I think the final piece, which is most exciting, is can we then take that and insert into the taxi some type of electronic or digital payment device with fares going directly into that account. We can only really do that with taxi industry buy-in, but I think we're best placed to do that because we have Santaco and the industry as a 25% shareholder in our business, so they would participate in this from the outset. We see this as a really exciting opportunity. That final piece of the transactability in the payments, we would need to partner either with a bank or else some type of technology player that can assist us in that regard. And we're starting to have those type of conversations. But it is kind of a journey. First it's telematics, then it's rewards, then it's credit, then it's transactability, and then it's receiving payments, moving into the payment cycle of this vertical. But we're quite excited about that. There's still nothing on the YouTube chat, so I don't know if there are any further questions coming through on the conference call.
We have another question from Bruce Williamson of Integral Asset Management.
Hi, good morning, David and Sean. Thank you for the presentation. Just talking about sort of being able to install payment systems into the taxi industry. There's been quite a bit of press lately on SARS now going to have a careful look at taxi accounts and books. And can you comment? Sitting on the outside, I've often wondered what their books look like and just how up to date they are on tax. is SARS likely to cover and uncover any big surprises for you?
So first of all, just to kind of bust a few of those myths, kind of frustrates me a little bit when people say that the industry pays no tax, because indirectly there's a lot of tax paid by the industry. First of all, if you look at fuel levies, which are higher than ever, we have calculated that the industry pays in excess of 7 billion rand a year in fuel levies. So that is a big contribution. And then, of course, there's VAT on these vehicles, and that's over 1 billion rand as well. So just to say, the taxi industry certainly does do their bit in paying their taxes. But I take the point. It's very difficult to track income tax. What we do, it's not our job, quite frankly, to track income tax. What we do is we make sure that our operators are registered at the time of applying for a loan, but we can't monitor that on an ongoing basis. What I think will happen is we like industries where we see further, growth in regulation. So industry is moving from informal or self-regulated to be formally regulated. And the taxi industry has been on this journey now, since we've been in it, well, forever, quite frankly, and we've been on that journey with them for the last 2 decades. I think to the extent that you can introduce some type of payment mechanism, that will assist in making the entire industry more efficient. So I don't think there'll be a net cost or outflow to tax. I think the entire industry becomes more efficient and better. We've seen taxi taking market share from bus and train. I mentioned before, taxi grew by 16%. Bus and train both went down, one by more than 20 and the other by more than 40%. Taxi moves 15 million commuters, bus and train together only 1. That will continue, and if you can get a better payment mechanism, then I think it will grow even faster. So I think efficiencies around making the taxi industry better, which eventually should result in a greater flow for everybody. And yes, it might result in some income tax being paid or more income tax being paid by the industry.
Great, David. Thanks very much, and well done on just more and more progress. Thank you.
Thank you. Still no questions have come through on the YouTube chat. We've probably got time for about we've got time for a few more. I don't know if there are any more questions on the call.
We do. We have a question from David Telford of Avial Capital Markets.
Hi, David and Sean. Just thanks for the presentation. Just got a question on the net cash position of the group. Understand the group's always been in this net cash position, and from what I understand now, you got net debt position and available facilities of close to 1 billion. How should we think of that going forward? Are you comfortable not having excess cash on the holding company level? Showing how it has been so helpful for acquisitions in the past. And should we see this net debt position kind of as a new sustainable capital structure?
Thanks, David. I'll start there, and then maybe David will jump in. Just to start in the subsidiaries first, and then obviously I'll get to the group. We do sort of quote runways in both taxi and TCRS in excess of sort of 18 months in both, in terms of originations in those businesses. So sort of we have what we need in those businesses to continue our originations and continue our growth. At the holdco, as you say, we have in excess of 900 million rand. At the moment, debt is relatively, I guess, all-time sort of at all-time lows in terms of cost, and there's no rush for us to go out and replace that with cash or with equity at the moment. We're relatively comfortable to run a net debt position as we stand at the moment. Obviously, as things change, we may reevaluate that, but it's not we're not uncomfortable with where we are at the moment. So I think in the short term, we're very, very comfortable with the net debt position at GEO level.
I think if you look at the assets below GEO with a few, we at the moment it's a few 100 million rands worth of debt, but even with a few billion rands worth of debt, it's well supported. I'm not saying we would go there, but we've got adequate ability to utilise various mechanisms. We could use debt at the holding company level. We could obviously use equity at a holding company level, and I mean, you've seen that we're in negotiations to increase our stake in We Buy Cars, and I think first of all we have adequate facilities to pay for that. If it were to happen right now today, we could do that, but I think going forward there'll be lots of optionality for ourselves, and of course you all know Mark Hurwitz, who would engage with the markets and work out what the best way to fund that going forward could be.
Thank you.
So something here from Louis Kruger. That should come up on the screen in a moment. Who owns the balance of VBuyCars post-acquisition? Is Fledged Capital still involved? Thanks, Louis. Very good question. To the extent that this deal, that we can conclude on this deal, as I said, we're still in negotiations, but the shareholding will be 74.9% TC, and the remainder will be held by the founders, Faan and Dirk van der Walt. They'll own 25.1 of the business. And we like that. We've always been, Transaction Capital has had a long history of working together with very entrepreneurial founders, where typically, they've taken the business to a certain level, and we can then add on additional skill sets to grow that business further. What are we excited about here? First of all, we've been a minority in this business now for 8 months. We've seen how resilient the business is in this COVID environment. We've seen how phenomenal the management team is and how passionate the team is that Faan and Dirk have built. Structurally, we think it is probably the most exciting asset class internationally. Used vehicles are growing in the world as well as in South Africa, and that's driven by affordability constraints. There's an e-commerce element or a digital element coming into this industry as well, which is pushing growth. And we're very excited about that. If you look internationally, there are many comparables of fast-growing businesses of this type. I think what makes us unique is that we're actually profitable. Most of these international businesses are not yet profitable. High revenue growth, but not yet profitable. We have both high revenue growth and high profitability growth. And that might open up some international opportunities for us, so we're excited about that. And I think what excited Faan and Dirk and the management team there is our ability to develop this business around finance and insurance, and other value-added products. I mean, that really is a skill set that that we've had for 2 decades now, and hence the reason why the other shareholders contacted us to say, let's try and accelerate those put and call options and try actually cancel it all into one transaction now. So that is what we're negotiating at the moment. And I guess you need to keep on watching those wires, and hopefully we'll be able to, in the short term, come back with some type of deal. Sean, anything that I've left off there? No. There's still no further questions on the YouTube chat. Anything further on the Chorus Call line?
We have no other questions on the line, sir.
Great. I think that concludes the presentation. I want to thank everybody for your support over the years as shareholders. And I want to thank you, obviously, for logging on and listening. And until next time, stay safe, stay healthy, and stay productive.